Buy the dip, a term we hear all the time when it comes to investments. Should you buy the dip? What does it really mean to buy the dip? When should you buy it and when should you not buy it? That's what we're going to talk about right now. Let's jump into it. So the first thing that I want to discuss with you guys is that it all comes down to mentality. For example, let's say you invest in a company that's worth $100 a share, and then that share price falls to $50. Well, if you were willing to pay $100 for it, why are you not willing to pay $50 for it? A lot of the times what happens is that there's fear that sets in, a lot of fear. So then people say, well, I don't want to lose more money, but I don't think you really understand how powerful the math is when you actually buy the dip. And when it happens, you have to ask yourself, do you really believe in the company? Because if you really believe in the company, then you would definitely want to buy the dip and get cheaper prices on your assets. So let's take a look at the math here. I wanted to show you this because I think it's so important. I think it's sort of an investment like 101 in terms of knowledge base, but at the same time, this is so critical and a lot of people just don't get this right. So this is an example. Let me just put more of it on the screen for you guys. Okay, so right at the top, it says, let's say you buy a coin priced at $20 with $100. You get 5 coins. Then it dips to $10. You put $100 in again. So now you got $200 invested. You now get 10 coins. A lot of people, when they think about it and don't actually do the math out, they think, oh, that the average would be 30 divided by 2, meaning $15 per coin. But that's wrong. That's incorrect math. So you have 15 coins and a $200 investment, which means you actually averaged, your average cost per coin is now $13. So initially it's easy to think that it's just half, but it's actually less than half because your buying power increases with the drop in price. So what does this ultimately mean? It means you only need the coin to go up 33% for a break-even point, even though the coin value dropped 50%. So your reward is far greater than the amount that the security dropped. This is a very important concept, and it's one that you really have to digest because this is a key metric to be successful on your trades, whether it's in the stock market, whether it's in cryptocurrency. This is just sort of a basic fundamental set of math that will guide you on your journey to making more powerful trades when you choose to make them and when the dip happens. So what are some other things to consider when it comes to buying the dip, whether you should buy it or not? Well, the first thing you have to ask yourself anytime you're buying any dip, whether it's in the crypto markets, the stock market, doesn't really matter, is what's the overall sentiment of the economy and what's the overall sentiment of the market? So right now, the cryptocurrency market has been in a bull market. Now, lately, because of the new variant out, there was a lot of bad sentiment in the market, a lot of fear coming in, and people were starting to question whether this was going to turn more towards a bear market rather than just a temporary dip. So we watched the crypto markets go down. And even though that dip happened, I still believe we're in a bull market. So if I believe we're in a bull market, then I know it's time to buy the dip. It's time to buy more. Now, the timing in which you buy it may depend on your personal preference, but whether or not you should or shouldn't buy it should be clear based on your overall perspective of the market. And let's go to a chart and talk about a perfect example of this. So this is showing the Bitcoin US dollar price in March of 2020. So we can see here in February that the price was roughly $10,000, and then it dropped all the way down. It wicked down to $3,800 within 3 weeks. Okay, so it lost, 70%, 65% or so of its value in 3 weeks. Now, when we look beyond that, we see that we have this nice V-shaped recovery and that it would have been a perfect opportunity to buy the dip. So that's one example where you could have made a lot of money, a ton of money really quickly, within a matter of just a few weeks. Now I want to jump to another example. This is regarding Chainlink. Now, I love Chainlink. I think Chainlink's a great project. Let me just remove the drawings. Overall, I think this is fantastic. Here we are on the Chainlink charts, and we can see that Chainlink, for the most part, has an upward trend, even though it's subtle right now. But we can look over the past year and see that Chainlink hasn't moved much. It's kind of been flat, roughly flat. So if we see a dip with Chainlink, yes, it may go sideways for a bit, but we're not seeing that massive V-shaped recovery that we've seen in the past. And you also have to remember that crypto markets behave different than the stock market. The stock market is much more resilient than the crypto markets. So if the crypto markets start to do a downturn or go into a bear market, that's very dangerous if you bought the dip, because now you could be looking at a 4-year crypto winter. Yes, I've experienced that. It's tough. It's very tough to go through. Now, with the stock market, that doesn't usually happen. And when it comes to the stock market, it's almost always the right thing to do. Buying the dip in the stock market, you're going to be right way more than you would ever be wrong. So that's it, guys. That's what I wanted to leave you with and just sort of give you an understanding of when you should and when you shouldn't buy the dip. Hit the like button. Hit the subscribe as well, turn on the notification bell, and I'll catch you guys in my next video.